In this video, we're going to be talking about how to trade the wheel strategy, how to sell cash secured puts and sell covered calls, what all this means. We'll even talk about the basics of options trading, just so you can get a whole understanding and a great foundation on what the wheel strategy is, options, everything that comes into play with this, whether this strategy is worth it or not, everything you need to know. So before we go any further within this video, I ask you enjoy it. You make sure you give the video a thumbs up and you subscribe. You turn on those post notifications, videos coming out every other day. I'm always trying to pump out as much content as I can on this channel, talking about dividend stocks, dividend investing, passive income, all that good stuff, helping everybody reach the financial goals that they deserve. But enough of that talk and enough of that intro. Let's get into the video. So if you are not new to the channel, you might be looking at my portfolio right now, and you might be seeing, hey Hunter, why did your dividend yield drop from 3.5% to 2.81%? And that is actually because I rearranged my portfolio. I started to think, and I was kind of just like, well, I have a longer time horizon than many investors. I don't need a high dividend yield. And so I started to aim more at the tech and cloud computing, which is lower yield, higher growth. And I started to switch some things around. I lowered my income fund, which was high yield, lower growth. And so I'm aiming for more of a growth-oriented stock portfolio. I might try and get my dividend yield actually down around 2.5%, maybe even 2%. I'm going to do some more analyzing and research on what I should really be doing to make sure that I'm maximizing my portfolio's potential. But if you want to get access to this portfolio, check out the link in the description or the comments below. It's 100% free. You can go check it out on M1 Finance and check out the links to get free $50 once you sign up and deposit $100 with M1 Finance. But enough of that talk, let's talk about the wheel strategy. So first off, what even is the wheel strategy? The wheel strategy is a systematic way to sell option cash secured puts and covered calls as part of a long-term trading methodology. In essence, you keep selling options on stocks that you're bullish on to generate monthly income. So first off, if you don't even know what an option is, let's talk about that. What is a stock option? A stock option gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and date. So what that means is, let's just take, for example, let's look at the stock Microsoft and actually give you a real visualization of what that is. Now we're going to be using Robinhood to show you this. I actually have no money in Robinhood. I have like $50 in Robinhood. It's like Dogecoin. It's like just play money. And what we'll see right here is that it says trade Microsoft options. If you click this, it's going to bring you up to a screen that says buy, sell, call, and put. Now, pretty much what you want to do whenever you're trading the wheel strategy is you want to be selling calls and puts. We'll talk about that more specifically, but let's just talk about the stock option definition and explanation. So let's just say, for example, I wanted to buy a call on Microsoft that expires on December 10th. So that is this upcoming Friday, as I'm recording this on Saturday, December 4th. What we'll see is that this, let's say I wanted to buy the $330 Microsoft strike price. Long call. What does this even mean? So your strike price is the price at which you are willing to pay for shares of Microsoft. So you got $330. That's me saying if by December 10th, if Microsoft goes up above $330, well, I have the right to pay only $330 a share. I don't care if the market value right now is $370 a share. I bought this option, so I'll get to pay $330. And why do I get that right to do that? It's because I'm paying for this option now. You might be like, well, you're paying $2.68. That's nothing, Hunter. Actually, it's $268, and it's because options work in 100. What that means is every options contract that you purchase or sell is 100 shares worth. So this is pretty much saying I can buy 100 shares of Microsoft at $330 a share. If it goes up above. Now, if the stock price is below $330, I'm just going to lose my $268 and move on with my life. But that's if it's below. If it's above, then I made money and I actually did very well. And you can sell the contracts and all the different stuff, but we're not going to talk about that in too detail. I just want to give you a basis of what options trading really is. So the wheel strategy is whenever you are not buying these options, but you are actually selling the options. So basically, you repeatedly sell cash secured puts to collect option premium. Should you ever get assigned, which means that, like, let's say, for example, you sold an option on Microsoft stock and you sold a $330 strike price, okay? And you sold that call and the strike price is, and the current price is at $335, and you get assigned. That means you're going to have to sell your 100 shares of Microsoft at $330, even though the price is at $335. But you get paid a premium. So we'll look into that a little bit deeper in a few minutes. But then while holding the stock, you sell covered calls on it to receive more premium. And premium is pretty much just cash. It's a fancy term for it. Once eventually your stock gets called away, you have to sell the shares and then start again going on back to sell more cash secured puts on the same or another stock. Now, there is kind of 3 different ways for you to make money within selling on the wheel strategy. You can make money from selling cash secured puts, money from collecting premium by selling covered calls, and money from profit of your capital gains. So let's talk about this. Selling a call. What is selling a call? You own at least 100 shares of the stock. So let's say, for example, I owned 100 shares of Microsoft. That is where you putting up 100 shares of a stock that you own up for sale at a price that you're willing to sell them at. Example, you own 100 shares of company XYZ. You then sell a call option. You get paid a premium to sell this call. The premium is just cash. Either by the expiration date, your option is going to expire worthless and it does not get exercised. You still have your premium collected and you move on. You keep your shares are returned back to you, and you keep your money. Or your option will get assigned and you have to sell your 100 shares at the strike price of the option, even if the current price is higher than the strike price. Now, whether you get assigned or not, you will be collecting your premium no matter what. Let's go into a deeper analysis of this. Let's take, for example, I wanted to sell Microsoft call. Okay, I think on December 10th, I don't think that Microsoft is going to be any higher than $330 a share. So what am I going to do? I'm going to take this and I am going to place this trade, selling a covered call. Now, it's called a covered call because you own those 100 shares before and you do not want to sell naked calls, which is pretty much selling these calls. And if you get assigned, then you'll have to go out and buy those 100 shares. It's a very risky thing to do, especially if you're trading with a smaller portfolio. But we'll look at this. Let's just take, for example, I own 100 shares of Microsoft. I will sell my 100 shares at $330 per share, and I'm okay with that. And so in order for me to do this, because there is that risk that Microsoft stock could be above $330 a share, I'm going to get paid $268 to place this trade. That $268 is going right into my buying power, and I can take it out of my account if I wanted to, and I could go buy Chick-fil-A. I could use it to buy more Microsoft stock. I could use it to do whatever I want. That money is mine any way that this trade goes. Now, let's say that by December 10th, that Microsoft stock stays below $330 like I assumed it would. What happens? I keep my $268, and my shares, my 100 shares on the options I sold, are kind of just like locked up in my brokerage account right now. But until December 10th, if that trade expires worthless, my broker, let's just take, for example, Robinhood, is going to send me back my 100 shares, and I can sell another call the next week and make more premium and just keep trading like that. But what if Microsoft stock is above $330 a share? What's going to happen is you are going to get assigned. And what that means is you're going to have to actually sell those 100 shares. Now, you will sell your 100 shares times 330. I'm doing this off the top of my head. I want to say it's $33,000. And so you make that premium collected, which is insane stuff, okay? Now, that is what happens whenever you sell the calls. Now, I'll talk about selling the puts, and actually I think it's important to sell cash secured puts before you sell covered calls within the wheel strategy. Now, let's talk about this. Selling a put. You do not own at least 100 shares of the stock yet. This is where you're saying you are okay with purchasing 100 shares of a stock that you do not own at a price that you're willing to buy them at, which is also known as the strike price. Example, you want to buy 100 shares of company XYZ. You then sell a put option. You get paid premium to sell this put, and the premium is just cash. Either your option expires worthless, you don't get exercised, meaning you don't have to purchase 100 shares, you still keep your premium collected, and you move on. Or you have to buy 100 shares of that stock at the strike price of the option, even if the current price is lower than the strike price. Let's use Microsoft again as our example. Sell, put. That is what you click. So what you want to do is, let's say Microsoft right now trades for $322.70. I don't think that Microsoft is going to be lower than $315 this week by December 10th. So I'm going to place this trade, and it's going to give me $340 to do this trade. Now, the option prices, the credits that you make differ from every stock. We can look on that later in the video, but let's talk about this. You are, by placing this trade, you are saying, I am okay with paying for Microsoft stock at $315 a share, even if the price plummets. Okay, that is the risk you take, and that is why you're getting paid. Because the price could plummet to $295, and you will still have to pay $315. But you still got $340 to make. So keep that in mind. But let's see. What we'll see right here is what if it goes down. Then you're going to get assigned, if it's below $315 by December 10th, you're going to get assigned and you're going to purchase 100 shares of Microsoft at $315 a share. Now, if it stays above $315 a share, you're going to move on. You're going to keep your $340 and all that money that you put up for collateral, because if I want to place this trade, check this out. I'm going to need to put up $31,500 in collateral to show that, hey, I can actually place this trade. But then my collateral will get released back to me and I can use it to make another cash secured put. And that is kind of the main basis on cash secured put. Your collateral is your cash that you can use to buy the stocks, and it's a put, cash secured put. Now the wheel strategy is when you sell these cash secured puts on stocks, you collect the premium, and then sometime sooner or later you're gonna get an exercise. Like, it's almost bound to happen. Okay, so you get exercise, you buy your shares, and then the next week, what do? You go out and you sell a call on that stock. Let's say, for example, you did get exercise on the $315 strike. Well, now your average share price on Microsoft is $315. So you can just go out and you can sell the $325 strike. That's going to be a $10 difference on 100 shares. That's a $1,000 profit that you make just alone on the stocks. That's assuming that everything goes in play and you actually get assigned at 325 strike. And plus all the premium that you collect, that is how this strategy is very, very powerful. And selling these calls and selling these puts, that's what a lot of these ETFs are doing nowadays. That's how they pay such high dividend yields. For example, JEPI or QILD, the covered call ETFs, that is what they're doing. And that is how they're generating so much income for their investors. And that is how you trade the wheel strategy. You can look on different stocks, for example. You can see right here, if you want to go on SPY. Oh, let me mention this before I forget. On trading the wheel strategy, do not go out and trade these on like penny stocks, on very risky stocks. Invest in trade the wheel strategy if you're going to. Remember, everything I say is not financial advice, but this is just like good suggestions in my personal opinion. Trade and do it on stocks that are uptrending. For example, SPY. For example, we can look on Microsoft. Microsoft is a great example of a stock that is a very, very solid uptrending stock over the past year. Green momentum. Now, another great time to do this is kind of in flat markets. Take, for example, the SPY over the past 3 months or over the past month. This is like, you're not really making that much money from gains or anything. So what are you doing? You're trading options. You're trading and selling these covered calls and cash secured puts, making great money on your investment. And you get to collect these dividends, and it's a great way to just make your portfolio a complete cash cow. Now, if you actually just want to trade the wheel strategy, you can do stuff like trading the wheel strategy on 3x leverage ETFs, which is pretty big stuff. And because they're 3x leverage, meaning that they use leverage to get bigger gains, but also because they use leverage, they incur bigger losses. The premiums on these options are going to be more expensive, meaning you get paid more money. Because the share price is 76 bucks, you can see that these prices do differ from things just like Microsoft's price did. So keep that in mind. That is how trading the wheel strategy works. And everybody, we will look on this real quick just so I can show you. Here's just some options terminology I think is important to know before you go into trading these kind of options, which is call, you're bullish, you purchase a call option, hopes the stock price will go up. A put, bearish, you purchase a put option in hopes that the stock price will go down. You've got the spread, which is a price in between what buyers are willing to pay and sellers are willing to sell at. You got a premium, which is the price you pay for an option when you buy an option, or the price you're paid when you sell an option. So it's about the money it's literally the cost of an option or the money that you get paid to sell the option. You've got the expiration date, and that is the date that your option will expire, or the date that you can exercise your contract until. These dates are usually on Fridays and close when the market closes, 4 p.m. Eastern time. The bid is the ask, is what the buyers are willing to pay for the option, and the ask is what the price that sellers are willing to sell at. You've got the strike price, and that is the price which you're willing to buy or sell 100 shares of the underlying stock on the option. And you got the Greeks, and the Greeks is a term used in options to describe the different dimensions of risk involved in taking an options position. There are 5 different Greeks. Now let's talk about what these Greeks are. These are can be very complicated. I suggest if you really want to learn what these are, you go watch a video on what the Greeks are. But you've got delta. You can look up, for example, right here. If we go to look at Microsoft, trade Microsoft options, let's just go at the first option we can find. Let's look at the $322 strike. You've got the delta, gamma, theta, vega, and rho. So let's look at this, delta. This represents the rate of change between your options price and a $1 price change in the underlying stock. This is the price sensitivity of the options price relative to the price movement of the underlying asset. So let's take, for example, right here. This option contract is $628. If Microsoft stock were to go up $1 to $323.70, relatively speaking, this options contract should go up $52. That is how that works. Now, gamma. This represents the rate of change between an options delta and an underlying asset. Gamma shows the amount of delta would change given a $1 move in the underlying security. So let's take, for example, this is 2. That means if it went up $1, the contract's going to go up $52, but next time it should go up $54 because you add this 0.02 to the delta, and that's how you get that. Theta. This is your time decay. And that is because whenever you buy an option, it keeps getting closer and closer and closer to expiration date, giving you less time for the option to move and make better gains. So every single day, this contract is losing $51 just because it's getting closer to the expiration date. Literally, the price could be completely flat, and that option is going to lose $51. That is why options are very, very risky. Now, vega. This represents the rate of change between an option's value and the underlying stock's implied volatility. Looking right here, implied volatility is 37%. Vega is 0.16. So that means if the implied volatility went up 1%, vega, your contract should go up $16. If it went down, your contract will probably lose $16. And rho is just kind of measures the option sensitivity to the interest rates. Really not that important, to be quite honest. But everybody, that is what I have for you in this video. So if you enjoyed it, make sure you give the video a thumbs up and you subscribe. You turn on those post notifications, videos coming out every other day. Thank you for making it all the way to the end of the video. Check out my portfolio in M1 Finance for some free money. And just check it all out. It's great stuff. Thank you again. Make sure to subscribe, turn on those post notifications like I said, and I will see you at the next video.